Good, what is it, Wednesday morning, Market Chameleons? Thanks for joining the show. Before we get started, make sure the right screen's up.
Good morning, Will. How are you?
Good, D. Sorry, technical issues. You see the screen?
Yep.
All right. Everyone make sure you read the disclaimer. Market Chameleon, Dimitri, and myself are not registered investment advisors or a broker-dealer. If you need investment help, please seek out a licensed professional. This show is for Market Chameleon informational purposes only. With that, Dee, do you want to get started?
Yeah. Let me share my screen here. Um, and a reminder or a quick note, uh, if you're joining us for the first time, we do these shows in the morning, Will and I, for uh to help answer questions that you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will is keeping an eye on it and he'll let me know and read it back to me. And to give you a couple minutes to put those questions in, we're going to take a look at our pre-market report, see if we could get insights, what's going on in pre-market hours, and then we will move on to our questions. So let's start out with our pre-market report here. And up top, we see a calendar view, and this allows you to click on a historical date. You can pull down a calendar over here if you wish to, and go back to see what happened in a pre-market on a particular date. But here we show the last weeks of data and some summary statistics of what happened in a pre-market that date. And it's really to help compare today, over here on April 3rd, what's been happening recently. It also allows you to eyeball if there are any trends or any particular date in the last week that was unusual. So we're going to start out with April 3rd, which is today. And so far, we see there are 365 stocks trading higher in the pre-market, 387 stocks trading lower. We have 275 million shares trading on up volume, 58.5 million on down volume. If we convert that volume to dollar value, we have $681 million worth of stock trading higher, $2.2 billion worth of stock trading lower. So just looking at that, it seems that the trading so far in the pre-market has a slight bearish lean. Just really I'm basing it off the dollar value of the stock. But let's look at it from a couple more perspectives, and then we'll move on to the questions. And now I'm going to scroll down, and we have this more granular view. We see the stock symbols that are trading in pre-market hours with the price changes, volume, and the alerts. And we have a most active list, our biggest percentage gainers in pre-market and biggest percentage decliners. And here we have 63 stocks that made our percentage gainers list, 58 on our biggest decliners. And to make this list, we do set thresholds because stocks in the pre-market can trade with very little volume or very low liquidity. And if it meets the threshold, it can make it onto this list. And that includes small cap stocks. It includes ETFs, leverage products. So keep that in mind when we compare this here. It does seem that there's a slight more balanced, pre-market activity, maybe slightly leaning towards the bullish side. But to narrow it down to a small group of stocks, we could use our filters above. If you created a watch list and you track a certain group of stocks, you can filter this list by your watch list. I'm going to use this filter here in ETF. So when you click on it, you get these different ETFs to select from. We're going to choose the SPY ETF here. That's the S&P 500 ETF. And when we do that, the list below gets filtered by stocks that are holdings in the SPY ETF. So what we did was filter out pre-market report and pre-market trading to the group of stocks that are members of the S&P 500, right? And now we see 7 stocks here made our percentage gainers list, 8 on the decliners. And this also just shows a mixed bag. So far, nothing overwhelmingly points to, a strong directional lean or bias in pre-market. It's kind of a mixed bag, and depending how you look, from what perspective you look at it. And we did give it a couple minutes, Will. So if you have questions, I'll take them now.
Nothing's popped up yet, D.
Okay. All right, so let's default then to SPY. And we'll see if we could gain some more insights on some of our reports. And I'm gonna, let's go over this multi-leg trades report again, because it's fairly new, and this is going to get further updates. And the next webinar that's coming up with Interactive Brokers, I believe it's this next Tuesday, correct, Will? Tuesday at 2 p.m.
That is correct. Stock contingents.
Right. So the next webinar that we're going to do, it's going to be with Interactive Brokers at 2 p.m. next Tuesday. And what you will see is enhancements to this particular report, the multi-leg trades. And this will include trades that are multi-leg. So I'm not going to get into it now. And right now you don't see the enhancement yet. So you're not seeing this. We're going to release it probably, the day before the report comes out. And this will talk about multi-legs, but with the stock component, okay, tied to it. So we worked hard on stitching that data together and coming up with the interpretation. So I'm just giving you guys a heads up. You have to register for that webinar, but we're going to be discussing those and how that affects the strategy and what the intent might be behind the strategy. And even I was surprised, actually, on some of the use cases that we've been seeing when we started to run this software and identify the strategies, through our, proprietary interpretations. And a lot of, I could tell you, interesting things have been popping up that probably if you didn't see the data, you would not expect it. So I think it's going to be interesting. You guys could register for it, and we'll be shown like some real examples on that Tuesday. We'll discuss what contingent trades are, and then we're going to go through some actual examples that we find trading that day.
And I put that link in the chat, so everyone click on that to register.
Yep. So now with this report, right, what it's doing now is looking at the multi-leg trades that have more than one option tied to it. And then it's stitching together those option legs that are related, and based on an interpretation says this is the most likely strategy, right? So here in SPY, I know we go over this a couple of times, but I wanted to refresh it because it's going to look different next week. Because we are adding those. So just refresh what we're seeing now. Because as we tend to add analytics and other things, it's good to just stay on top of what we already have. So at this point, when we gathered all this data information, then we presented here, and here you have 66 different strategies that we detected that were used in SPY. And here we see the top 5 spreads that traded yesterday, right? So the first 2 were actually put spreads, but these 2 put spreads were here different expirations and different strikes, actually. That's why they showed up this way. Then we had a diagonal put spread. That's the third largest spread by volume that traded. We have a ratio call spread, C1/2, April 8th, 525, 530. This little 2 is saying that there are 2 options on the 530 for every one on the 525. That's why it's 1/2, right? So 1 525 for 2 530. And then we have another spread here, and here we have identified it as it could be a jelly roll or diagonal double straddle. So why don't we? Yeah,
we did a question just popped up from Michael S. He says, how do you get to this menu? He's saying mine has disappeared. You may need to sorry about that. Refresh.
So it's under options, multi-leg trades. So if you go to SPY options, multi-leg trades, it should be there. We did do a publish, I think, last night, so it should be there. Hopefully we didn't introduce a bug. So let me know if you don't see it. So why do we have 2 of them identified? Well, sometimes when you're looking at a strategy, it's not conclusive really without knowing which component. You have 4 legs here, so we don't know exactly if they're buys or sells on each one. So it could be either one or the other. So we don't know, and obviously, you could buy 2 puts like in this put spread, but it's not likely. The most logical conclusion is this was a put spread. So that's how we tag it. But sometimes when we look at it, and you could say, well, this could be 2 types of strategies, right? Just like if you're looking at a straddle, a call and a put, without knowing exactly what the other side is doing, it could also be a synthetic conversion reversal. So sometimes we don't know, so we'll list the 2 most likely, right? The 2 most likely strategies that it could be. So here it could be a jelly roll, right? So a jelly roll is a strategy that you do a synthetic in one expiration, right, versus synthetic in another expiration. So it's a synthetic. You could get long synthetic stock in one expiration and short synthetic stock in a different expiration, right? So what's the point of that? Well, the point of that would be that you're trying to capture the cost of carry differential between them. Okay, so if you think that maybe the market's dividend forecast is wrong in one area, or you think that the interest rate forecast is wrong on the term structure, or maybe you think that the cost of borrowing stock is wrong, then you might want to do a jelly roll, right? So the jelly roll is a strategy that tries to capture the cost of carry differences between what you're expecting in the market. Okay. So that would be a jelly roll. But when we're looking at it, we still have four different, right? That's not the only combination here between April and December. Another combination could be, well, instead of doing two synthetics, you could do maybe two straddles, right? So what's a straddle? Straddle would be maybe getting long one straddle in one expiration versus shorting a straddle in the other. Kind of like a calendar spread would be getting long in one, short the other, but this happens to be two different strikes, so we call it diagonal double straddle, right? So it's like a diagonal spread, except you do it as a straddle. Instead of like a diagonal call spread, diagonal put spread, you do it as a diagonal straddle. That's a possibility, right? Or you're rolling your straddle. So that's also a possibility here. We don't have enough information. We could try to dig deeper and kind of make more inferences, but the software tries to say what is the most likely, and if it hits on, there's most likely it could be two different ones here. There's a tie, it'll list both of them. Okay, so when you open it up over here, you'll see that there are two different types of strategies. And right now it's priced as a jelly roll. So that's the way to read those types of interpretations. So keep in mind, these are interpretations. We don't know. Nobody sends us a memo saying, Joe from over here bought this option, sold this option. That doesn't exist. So we have to deal with the information that's available. Okay. Now, coming up here, if we wanted to go back dates, right, we can go back dates and see maybe what traded the day before, April 1st. So when I clicked on it, came up with April 1st and so forth. But let's go back to that. Looks like a bug, actually. Yeah, so I'm coming back to April 2nd. For some reason, when I hit April 1st, it didn't stay there. This popped back up. So we could go back and see what happened the previous day and so forth. Here, this is a filter too. And I'm saying this because I did get a email overnight saying, there are no filters, but there are some filters here. So this next filter, it organizes the strategies based, or organizes the data based on the strategies that we interpreted, right? So this is a list of strategies that we were able to interpret. So you could see it's a long list in SPY. And it's organized by highest volume. So from yesterday, just having this filter, it looks like a report, right? What it says is that the total of all the spreads, traded 1.2 million, over 1.2 million options were involved in multi-leg option spreads with 10,406 unique type of spreads. And then below that, it lists the spread types, right? So put spread, call spread, ratio call spread, and these are organized by the most contracts, most volume. So put spread made the top of the list, 468,000 contracts yesterday traded that were part of a put spread, right? And over 2,333 different types of put spreads traded, different combinations. So if different strikes or different expirations. The next one is call spread. Then you got the ratio call spread, diagonal put spread, ratio, just ratio spreads in general. Here's the jelly roll we were talking about. So you could see the jelly roll, there are only 13 different jelly rolls. If we click on it, here are the 13 different ones. So you could see the first one, 38,700, but the next one is 160, 28, 28, 16. Again, these could be jelly roll or the double diagonal strike. But there are only 13 of those. When you come back up, let's go back to all. All right, open this back up. And here, what else we could tell is that, well, what are the popular strategies? What are other people trading? What are they looking at? What are from highs to lows? How often, do they trade? And this gives us a better picture of how people are using the options, right? How are people using the options in SPY, or how did they use them yesterday? And that's from the perspective of multi-leg trades. And some of you trade multi-leg spreads. Some of you, I know this for a fact. The either vertical spreads, calendar spreads, and so forth. So even in looking at the put spreads, right, when we were looking at the put spreads, when you're considering it, one thing is to look at, well, what are other people trading here? And is this something that, when I'm looking for a put spread and looking at the volume, is this something that maybe that I would participate in? Because now I kind of have a better picture of where the fair value is and where things are trading, right? And maybe where potentially I could get executed. Maybe if I'm looking to buy a particular spread, well, this one looks, I'm just looking at it from eyeball, but this one looks interesting because it was executed near the bid. Maybe that's a spread. Obviously, if you're buying it, right? If you're a buyer of a put spread, the lower the price you could get, the better, right? You want to buy it at the lowest price possible, and if you're selling it, you want to sell it at the highest price possible, right? So if we're looking at just these put spread where they're trading, and relative to the markets, relative to the bids and offers displayed, right? If we're looking at it and saying, well, maybe, this traded 47 times, this traded 58 times, we'll open that up. So it trades a lot. So maybe there's somebody there on the sell side, oops, what just happened here? Oh, well, I clicked on the wrong. So you could see here, it's been trading a lot. So what is this? So what is this helping us do? Is say, well, if I wanted, if I do want this particular put spread, like this fits what my outlook was, right? I'm looking at a put spread, and this kind of fits it. The expiration fits it. The strikes kind of fit it. And now I'm looking at it and saying, okay, well, here, if I'm a buyer, it seems like that where it's trading, I could maybe get a pretty good deal, right? Pretty good, decent, decent execution. So so let's just take a look at that, right? Let's say instead of buying it for 80 cents, right? Instead of buying it for 80 cents, let's say you are able to buy it for, let's say 75 cents, right? If that because it's trading there and you look at it, you put it in, you buy for 75 cents. So what did you save here? You save yourself 5 cents, right? And the whole thing cost you 75 cents. So what you did was just save yourself 6.6%. Just think about that, 6.6% on a trade. If you're making an investment, right? If you're making a trade and you trade it efficiently to save yourself 6.6%. If you could do that consistently, just think how that would add up. Think about that edge. Like what, don't think of it as 5 cents. Think of it as relative to what you're paying, right? Like relative to what you're risking. So is 6.6%? Does that make sense? How hard is it to make 6.6%? So let's think about it. If we put our money into a treasury bill right now, to make 6.6%, I have to go out, what, like 1.5 years or something, right? So if you could do that just on the execution, trade more efficiently, right? This is what we're talking about, trading more efficiently. That adds up to a lot, right? That could make a difference between success and failure. Do you guys see that? So, Will, I'm coming up around 9:30, but just wanted to show some use cases and how to read this report, just because we are going to be looking at it more next week and it's going to look different.
Well, that's awesome, dude. That's a great new report. Good for the chameleons to have that information in front of them now. Thanks so much. I did put in the chat the link. You have to register for that IBKR webinar that Dimitri's going to be doing. You'll see it up there, stock contingent options trades. Just click on that link and register, and they will actually send you a notification when the webinar is actually done if you didn't make it live, and you can watch it at your convenience as well. So awesome job, Dima. Thanks so much.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys